Hi, it's Josh here. I wanted to show you how to add your assumptions and your financials into the portfolio modeling tool as one of the first steps in the process so that we can build out a portfolio model. So the first step is actually adding the members in on the portfolio. So if you have multiple members, anywhere up to 10 members in a normal portfolio, so outside of super, you can have 10 members, and inside of superannuation, you can have up to 6. You invite the additional members as read-only members, so you're like an admin, and you can invite, say, for example, a husband and wife or partner into the ecosystem. The reason why we do this is you may be on different incomes, and this obviously affects the tax calculations in the back end. So, for example, you would stick in your husband or wife or partner's email, and then select the portfolios that you wish to invite them to, and just click on here and then just press send invitation, and it will send them an invite into the system. However, without them even accepting the invite, you can continue to add them. So once you've done that, we'll have the original member, which is yourself, or your original invited client, and then you can drop down and you'll then see multiple people on the portfolio. And you have to introduce the income for each party and the savings into or liabilities into the system as well for each independent member. Now, the most important one here is income because it's the tax calculation foundation. So what you do is you click on income, you want to enter your annual amount, let's just say it's $100,000, and we're going to put in a 3% annual increase and press save. Now we can add exceptions here, and this is important. If you're going on maternity leave or you're going on a holiday and you want to enter in a leave period, you can do this and you can put in how often you do it and when it starts and when it finishes, and it will adjust the income for that period, just so that you get more accurate data at the tax time inside the portfolio modeling tool. For now, we're just going to delete this. However, you can do that at any point in time. Now we want to add savings. Now total savings for Nick, we're just going to say is 150,000. And then there's a savings plan amount. So basically here we're going to see how much are we putting into our bank per month. Let's just say 1,500 per month, and with 3% increases in savings. Now what we typically like to see is that the annual increase in savings is actually reflective of the annual increase in the total income as well. That makes it a little bit more nuanced, but you're not sitting on a flat savings rate. It would be the expectation that you'd be increasing your savings ever so slightly. Each client or each person is different. Press save savings data. The reason why we want to save all the time intentionally is just so that we accurately capture the information. It's not half done. It's all correctly updated. Now, what we want to do now is we want to enter in our goals. Now, establishing what your cash flow goal is another video. But once you have established your cash flow goal, you put in the net amount of cash flow that you need. And I refer to net specifically because net cash in your bank is what you use to pay for things. Gross is before tax, and it really doesn't reflect what you actually are going to receive because there might be multiple beneficiaries of the portfolio, and therefore that number changes, whereas the net cash flow result does not change. So we're going to save that goal. And then we want to add liabilities. Now, this is car loans, personal loans. This affects your borrowing capacity. So we want to ensure that we're capturing these in there so that our borrowing capacity calculation is a little bit more accurate. Pretty easy to add a liability, type in what it is and what the amount is. Now, for assumptions, we have kept assumptions to a minimal. However, we still do need assumptions. DTI, debt to income ratio, is one of them. We've defaulted to 6, which is a pretty standard practice. However, sometimes if you earn a higher income, or you quite a high income, say 500, 600, 700,000, your debt to income ratio will increase slightly because you have more surplus cash. Now, it's really up to you or the advisor to highlight that might be ever so slightly higher for you, or it might actually be lower. So sometimes it might be like a 5 or a 5.5 if you've got multiple children, and that's really up for you to discuss with your broker and get a ballpark on that figure. Now, inflation, we've defaulted at 2.5%, which is in line or pretty standard. You can play and update any of these as you see fit. If you're using a buyer's agent or you are a buyer's agent, this is where you put in your fee structure, and then you will be able to select the using a buyer's agent in each purchase within the portfolio. Now you want to set a selling cost percentage per transaction, which is approximately 3%. And now we have the LVR mapping. So this is critical. If you want to extract equity up to a percentage or LVR that exceeds the standard, this is the standard format, so 70% for commercial, 80% for residential, 80% for mixed use, and then other. If you want to exceed that and say, for example, leverage up to 90%, you need to change this because our calculations will not allow you to extract equity up to 90% and incur LMI unless you specifically state that you want to do that in your portfolio. This is just a risk mitigation. We don't want people overextending themselves. It has to be a conscious decision. Me personally, I use 88% a lot, so I would use 88% in this calculation, and then potentially there are lenders that can go to 80% for commercial if you wanted to do that, or 75%, and then you press save assumptions. This is all the assumptions that you need to get started in building out a portfolio, and this is relevant to your actual portfolio and also to your scenarios. However, when you're in a scenario, you can change any of these assumptions at any point in time to simulate, I'm changing my job, I'm earning more income, what if my wife went on maternity leave? All these things, you can then start comparing scenarios against each other with some really nuanced scenarios. I hope this helps.